Thank you for joining us for a fireside chat today with CEO Bobby Riley, CFO Philip Riley, and Ben McQueen, who does investor relations for Riley Exploration Permian. I am Jeff Robertson, Managing Director for Natural Resources at Water Tower Research. Before we begin, I would like to remind participants that our discussion could include forward-looking statements as of today, December 16, 2025. Riley's disclosures regarding such forward-looking statements can be found under the Investor Relations tab of the company's corporate homepage. Riley is an exploration production company whose current asset base is concentrated in oil-saturated, liquids-rich conventional reservoirs in the Champions area of Yoakum County, Texas, and in the Yeso Trend area of Eddy County, New Mexico. Management's primary goal is to generate sustainable free cash flow to fund growth in the underlying asset base and to return cash to shareholders through its common stock dividend. On July 1, 2025, Riley closed a $142 million purchase of Silverback Exploration 2, whose assets expanded the company's core Yeso Trend area. On December 4, just a couple of weeks ago, 2025, the company announced a sale of its New Mexico midstream project for $111 million and plus the right to earn an additional $60 million in payments over the next 5 years. Oil production averaged 18,370 barrels per day during the third quarter of 2025 and accounted for 100% of total revenues. Adjusted EBITDA in the quarter was $64 million. For the 9 months ended September 30, 2025, Riley generated about $100 million of free cash flow from its upstream operations. With that introduction out of the way, Bobby, Philip, Ben, thanks for taking the time to join us today.
Well, thank you.
Thanks for having us.
Let's start with the Silverback assets, which added about 47,000 net acres that are either adjacent to or overlap the company's existing Yeso Trend acreage in Eddy County. Bobby, since that deal closed at the beginning of the third quarter, can you just update us on where you stand integrating those assets into your field operations?
Yeah, I'll be glad to. I will say that through strategic workovers and returning wells back to production and artificial lift optimization, that we've been able to increase our production by about 50% over what the numbers we used to underwrite the asset. That was in September and October combined. We have identified numerous other opportunities to do the same thing on reworks, workovers, and lift optimization. So that's prior to drilling any new wells. That's just working over the assets that we acquired.
So, Bobby, were those opportunities things that you uncovered during the diligence process, or are those things that you started once you took control of the assets?
Well, I'd say mostly since we took control of the assets, since we didn't have that much of a deep dive into it other than our basic due diligence, we were pleasantly surprised at what we found there that were just real cherries to pick to optimize that production.
Is there much of what you might consider low-hanging fruit left on those types of projects?
I do. I think there is, as we systematically work our way through it. Just being methodical on how we do it. I think once we start our drilling program in 2026, we should have everything optimized by then.
Even before the Silverback deal, Riley had done some work on the gas gathering and compression assets in the Yeso field. When you add the asset base from Silverback, is there much plumbing that's still needed to optimize those systems as you at least hand the midstream project and ultimately the Birdie compressor station over to the new owners at Target?
Yeah, Jeff, there really is, and that kind of was one of the reasons that we thought it was opportunistic to do the deal with Target. As we expand our footprint there and put new wells down, and even optimizing some of the existing wells, we have to build out new low pressure gathering lines, compression stations, and then obviously get that gas into the pipeline for the takeaway. So as we stand right now, basically we've shifted that capital requirement to Target to put all that in place, and so we can focus on our drilling and completion portfolio.
And Obviously it's gas, but gas doesn't really contribute revenue. But is the real goal there to be able to eliminate flaring so you can produce more oil on that asset base?
Well, New Mexico is a zero flaring state. So we're required to get 100% of our gas into the system. And what we were striving for was basically infrastructure unconstrained to be able to develop at our pace so that we could optimize our return. And I think that's where we're headed. Excited about the deal we did with Targa. I think it was a real uh, great thing for our company to be able to get closed when we did. And it really was going to optimize the value of these assets for us.
You picked up a rig in October with the plans, I think you said on the call, to drill 8 to 12 gross wells in the fourth quarter. Will the new horizontal completions have an impact on oil percentages as you move into 2026? And I guess the follow-up to that is, are those completions expected to add new volumes really beginning in the first quarter of 2026 and beyond?
So the rig is currently in Texas. Since we picked up the rig, it's still drilling a program that we have established there. We will move it into New Mexico in early 26 and start developing that asset. So I don't see too much of a change in our gassiness over the next 2 quarters, probably until we start bringing on New Mexico assets in mid to late 2026. So all production numbers should go up very nicely. I mean, these things have a great production profile, and we're pad drilling these wells, pad completing them, with zipper fracs and bringing all these wells on primarily at the same time. So you'll see some significant production increases once these pads start coming on.
Bobby, can you talk about the impact that the Silverback deal has on your Yeso trend overlap, especially since part of this acreage overlaps leases that you already own interest in, and maybe help us understand how that affects the working interest, but also just the number of locations that you think you have identified?
Yeah, I think some of the acreage did overlap with some of our legacy stuff, but we picked up considerable amount of new acreage as well. I mean, I think on a net basis, we probably picked up another 60% of locations. And that's roughly, I would relate to about increase of about 97% of gross locations. So, in New Mexico, different from Texas, where we own 100%, we have varying working interests over here from anywhere from, say, 40 up to 90, 95. So this was a great fit for us that overlapped plus added additional acreage.
Well, let's touch on returns. When you think about the Champions area and the Yeso trend, how do those returns compare in your overall corporate profile?
Yeah, thank you. Fortunately, they're both great. If we had to split hairs, maybe New Mexico slightly lower. The wells tend to be bigger, more production, but then the cost is a little bit higher, maybe $1 million higher. Sometimes on federal land, you got another string of casing, a little bit bigger frac, and then the facilities cost is usually a little bit more because we're early in the development versus later in the development. But overall, really great returns on both. And then, as Bobby said, we got a lot more room on the Yeso. We're generally doing 5-well pads there, so have opportunities for efficiencies. We're optimistic on getting some of the well costs down and then really optimizing those returns.
Let's talk a little bit more about the New Mexico midstream project. Riley has consistently looked for opportunities to add value to its assets, whether through operating drilling and completions more efficiently, but also doing things above ground, like the power project in Texas that you have, and obviously the New Mexico midstream project, which might be the biggest. That project, as you alluded to, Bobby, was conceived to prepare the asset for full field development. Can you give any more background on how that project will support full field development now that it's in Targa's hands?
I think it's going to support full field development and basically give us an unconstrained ability to schedule how fast we want to develop this should we decide to pick up pace. I mean, obviously, the initial idea to build a pipeline to get constrained gas out of a congested area in the basin into a broader area with Targa worked out well for us. You know, we initially had all intentions of doing this in-house 100%, but obviously it's for a company our size, it was a big project that would have caused us to have competing capital between the DNC and the build out of the midstream. And it kind of probably would have not something that we could have overcome, but I think this where we're at right now, we're in a lot better place. You know, we spent roughly $30 million to get the compression plant up and running, but as far as the pipeline itself, it's just now clearing permitting stage. So the ability to sell that asset when it's still an idea for what we did with especially with the upcoming earnout obligations, I think was the right move for us. I'm very happy about that.
Excuse me. I think, Philip, it looks like Riley has invested about $30 million in upstream CapEx through the first 3 quarters of 2025. Can you just outline your thoughts around how you think about the rate of return on the midstream project now that you have the $111 million sale plus the earnout opportunity?
Yeah, rate of return, that's going to be quite high. We probably think about it more like a multiple MOIC. You're right. We had spent 30 through third quarter. We gave some public guidance that we're going to spend some more this fourth quarter. So you add that in there, maybe it's, another 15 million ballpark. But that's 2.5x. That's pretty nice for a kind of 1.5 year project. We feel good about that profit we made, but equally, it removes some of the execution risk in the state for us to do it ourselves, and then at the same time removes that future capital obligation that you and Bobby were talking about a few minutes ago. When we did the Silverback acquisition, our footprint expanded a bunch, and hence the build out need and capital expanded. So removing some of that future is equally important to us.
We talked a little bit about the earnout payments. I think you have the opportunity in 3 different tranches to earn $60 million over the next 5 years. I think 40 million of that, or 40 or $50 million of that, is really in the next 3 years. Philip, can you provide any more detail around the structure? I know the volumes on the payments are confidential, but just on the structure and maybe how challenging it might be to reach those thresholds.
Yeah. So first, just to clarify on the tranches, there's 3 tranches. There's a 30 million, a 20 million, and a 10 for the aggregate of the 60. We have time to do that. Once the pipeline's on service, we hit certain volumetric thresholds. We're pretty optimistic about hitting that. This is gas, as Bobby said. We're producing gas already. We haven't been flaring anything, and so as we start to develop more oil, gas comes with that. You got the good gassy mix out there, and we feel pretty good about hitting it pretty soon. Maybe we forecast 1 a year or so, starting in a couple years, but we're looking forward to it.
And those earnouts clearly incentivize you to drill or to develop the Yeso assets to put gross volumes into the pipelines. How should investors think about the impact those payments could have on the kind of rate of return that you look at in your development capital program for the Yeso asset?
Yeah, look, the cash is going to be fungible. It'll be nice to get, and we can use that for a variety of things, whether it's paying for the development, paying down debt, or doing something else with it. But we're feeling good about it. We're fully incentivized to achieve it, as you say.
Apart from the midstream considerations in New Mexico or even back in the Champions area, are there any significant infrastructure challenges that you continue to have to deal with in Yeso or Bobby over in Yoakum County?
Yoakum County, we're in pretty good shape. We're gonna add one or two additional saltwater disposal wells in the next year just to make sure we have plenty of capacity there. We still have some running room in Texas. New Mexico, we're aggressively trying to solve for a gas takeaway, like we've been talking about, for water disposal, and also for power. We do have plans to install a self-generating power unit in New Mexico as well. It's on the drawing board and will come online in late 26 or something like that. And we're working with third-party providers for takeaway capacity on our SWD requirements, so that the whole theme is to be able to develop at our own pace with no infrastructure constraints.
Riley's latest full year 2025 upstream capital budget's $89 to $95 million compared to the original budget of $110 to $130 million that was announced in March. The midpoint of fourth quarter total production is about 32,400 BOEs per day, including roughly 19,200 barrels per day of oil. Total production in the fourth quarter of 2024 averaged about 25,000 BOE per day, including 15,900 barrels per day of oil. I know that a detailed operating plan for 2026 won't be provided until March of 2026 when you report your year-end 2025 financials. But Bobby or Philip, can you just talk a little bit about your high-level thoughts as you think about 2026, just given the macro oil backdrop that we're confronted with?
Well, it's definitely a challenging macro, isn't it? I mean, I think we're a growth company, and we've demonstrated growth year over year through all the previous macro events that we've experienced. So I think we're going to be very opportunistic and different ways to deploy capital during this particular time that creates opportunities that it always has in the past. This last transaction really solidified our balance sheet. So I think we're going to have a lot of interesting options that make decisions on in the next few months. That could be production growth, it could be acquisition, it could be a number of different things, but I'm happy we are where we are in this situation.
I guess just from a production standpoint, it seems like with fourth quarter oil production guidance and some of the development activity that you have carrying over into the early part of 2026, there'll be some volume momentum early in the year, but just based on all of that. Is that a fair way to think about it?
Absolutely. I think you're on.
Bobby, your asset base is generally are conventional wells. How does the natural decline rate of your asset base make you think about investment rates and deploying capital?
Well, as you know, the decline rates on these conventional assets are a lot better than on unconventional assets. After payout, there's a considerable value in the tail that's left, which allows us to grow this production year over year with the type of spending that you saw us do in 2025. So, without being specific on 2026, I think the next month is going to give us a lot of clarity on really firming something up. But I expect that we won't be sitting back. We'll be doing something that will be very accretive.
Philip, one just last question with respect to the earnout payments on the Targa deal. Will those have much of an impact on how you think about either allocating capital to the Yeso play in 2026 or just allocating capital in general?
Yes and no. Just to remind everybody, about 2/3 of our undeveloped locations are in New Mexico already. We've been more constrained there because of the gas takeaway, and so we're hoping that's alleviated there by mid-year next year. And so that first and foremost, just we want to get after it there. Of course, it's a nice carrot to have that incentive. The first one is the chunkier one at 30 million, and so we're happy to get that. But in general, we're just happy to get after and develop that region because we see good results there, attractive returns.
From a timing standpoint, is it right to think that that would really be a second half 2026 into 2027 type program, just given that the pipeline needs to be put in the ground?
In New Mexico, you're right there, but we still have, half of our assets are in Texas. And so, we will be active in both areas. So I think you might see more of a smoothing profile in 2026.
And there could be some drilling in the first half in New Mexico, whereas you don't bring them online till the second. That's one way to deal with it.
Philip, just in light of the budgeting discussions, I'm sure that are ongoing, how do you think about upstream reinvestment rates in these kind of commodity price environments when you're trying to balance growth and the balance sheet? And then you have a hedge position in place for 2026, which I think has downside prices averaging just shy of $60 a barrel. What role do hedges play in how you think about planning the capital budget?
Yeah. So first half of the question, I think that goes to Bobby's kind of sentiment on we're going to, on the one hand, be continuing as a growth company and wanting to achieve that. At the same time, remain flexible in light of the pretty volatile commodity price environment. We'll see how it goes. By just simple math, if we were to reinvest the same dollar amount next year, our reinvestment rate's going to be higher simply because the cash flow's lower with a lower oil price. If things continue to play out, current prices here. Also, this year's hedges, just to segue into that, this year's hedges about a weighted average $66 floor price, whereas next year it's about a 60. About a week or two ago, that looked like kind of a net neutral. At this point, they're a positive. I'd rather not them be a positive, right? I'd rather be writing a check. But so we'll see. But I can certainly see the reinvestment rate being higher for just those dynamics. And we'll stay flexible with it and probably treat it each quarter as it goes.
Bobby, just to wrap our discussion up today, 2025 has been a very active year for Riley, given the acquisition and the disposition of the midstream assets. Can you talk about it, maybe again from a high level, how you think those deals position the company to drive value as you look out into 2026 and really over the 2027 and beyond?
Yeah, I think I'm kind of glad that I'm getting a chance to kind of repeat some of what my thoughts are. But those two transactions, the Silver Creek, Silverback acquisition and the Target sale, really clean up our balance sheet good. Our leverage ratio is right where we're kind of in a sweet spot. We have the rig running right now in Texas. Every one of these wells basically is creating a DUC that we can flip a switch on anytime we want to go bring those wells on opportunistically. I mean, there's no really set schedule on completions. There is some scheduled pressure, not very much on drilling. But drilling and getting the pipe set and then standing by waiting to bring the frac crew out is a good place for us to see some quick results when the market starts turning in our favor. So I think you're going to see us active in 26, much like we've been in 25 and 24. So we're moving in the direction where we're continually trying to increase our inventory and replace our inventory year over year. And we think we have our finger on some of those opportunities.
Well, it sounds like a solid balance sheet, a solid asset base positions the company to be able to take advantage of any kind of turbulence that come in the market and still grow. Bobby, Philip, Ben, thank you so much for taking the time to join us today.
Thanks for hosting. Appreciate
I'd like
it.
to thank our participants for joining us for our fireside chat with CEO Bobby Riley, CFO Philip Riley, and Vice President Ben McQueen from Riley Permian. Our research can be accessed from our website, www.watertowerresearch.com. The views expressed in this fireside chat may not necessarily reflect the views of Water Tower Research LLC and are provided for informational purposes only. This fireside chat may not be redistributed or reproduced without the written consent of Water Tower Research and should not be considered research or recommendation. WTR is an investor relations firm, not a licensed broker, broker-dealer, market maker, investment bank, underwriter, or investment advisor. Additional disclosures can be found at watertowerresearch.com. Once again, Philip, Bobby, Ben, thank you for joining us today.
Thank you.
Thank you.